In the first segment, let me touch base with Karan Batra. He's the founder CEO of charterclub.com. Karan, hi, good evening. Thank you so much for taking time out to chat with us. Just want to start by asking you, what is the kind of checklist one should prepare if they want to apply for ITR returns for FY20?
Hi, good evening. It's always a pleasure to be on the show. Coming to your question. So the first things first, a person should have details of all the incomes and expenses which he has done during the year. Apart from that, he should collect the TDS certificates from everyone who has deducted the TDS. Many a times people only rely on the Form 26AS, but frankly speaking, sometimes the data in Form 26AS is also not 100% correct. So it is better to rely on the Form 16 and the 16A. And the person is also advisable to have a record of all the investments which he has made, so that he can claim all these deductions and save out on taxes.
Okay, all right. How should one go about it? I mean, if you could tell us about if one has to apply for a salaried person, house or a property or any other incomes that they want to apply a return for. How does it vary?
See, if a person has salary income or has rental income or has interest income, then he can file ITR 1. And ITR 1, frankly speaking, is the easiest form to file. You go on the income tax website, there's an online system, there's a web interface, and you just mention the details and it is done in 5 minutes. However, if you have, say, income from other sources, like you have multiple house properties or you have capital gains, then you cannot use ITR 1. Then you shift to ITR 2. And in case you are a business owner, if you're a small business owner, you can use ITR 3, ITR 4. And if you have a business which is auditable, or if you have a business in which you're not availing for presumptive tax, then you can use ITR 3. To be frank, ITR 3 is a bit difficult for a common man to file it himself, and ITR 1 is the easiest.
Okay. All right. And what are typically some common mistakes or errors that people are bound to make while filing for returns?
The one mistake which we have seen that a lot of people do is that they don't disclose the interest on the saving bank account. A lot of people, they miss out on disclosing the interest on the savings bank account because many a times that is not disclosed in the Form 26AS. So in this case, what the person should do is he should go to the banker and take an interest certificate. The bank gives an interest certificate. Moreover, from the bank statement as well, this can be fetched. So this is one mistake which a lot of people do. Apart from that, if you've made investments in the name of your wife, then the income which is earned on such investments, that ideally is not taxable in the hands of your wife, this is taxable in the hands of the husband. So this is also required to be disclosed. So these are the two most common mistakes which a lot of people do.
Okay. All right. Let's also talk about another important aspect, which is dividend income. Dividend income was something that was exempt all the way until March 31, 2020, but now it's taxable. So what is the kind of what kind of a rate is applicable for those who are filing a dividend income for the first time?
So till 31st March 2020, dividend was tax exempt in the hands of the shareholder. So the shareholder who used to receive the same, he was not required to pay any tax on that and used to disclose this as exempt income. However, from 1st April 2020, this income is now taxable and is taxable as per the slab rates of the individual. So if a person is in the 30% slab rate, he'll pay 30% tax on that. And if a person is in, say, in the 5% slab, he'll pay 5% tax on that. This is required to be disclosed as income from other sources. It is also important to note that if the dividend is more than 5,000 rupees, then the company who's paying the dividend, they will also deduct TDS. So earlier the rate of TDS was 10%. However, it has now been reduced to 7.5%. So the company who's paying the dividend, they'll deduct tax, they'll deduct TDS at the rate of 7.5% if the amount paid is more than 5,000 rupees. And the shareholder, if he says that, okay, his income was tax exempt, he can also submit Form 15G or Form 15H for non-deduction of TDS. So this form 15G, 15H is the same form which we also submit to the banks for interest income, for non-deduction of TDS on interest income. So the same form we'll submit to the company for non-deduction of TDS.
Are there any exemptions as well for dividend income? Because in the earlier practice, there was exemption for domestic companies, right?
Yes, in the previous regime, so till last year, this was exempt. However, from this year onwards, it is taxable and the entire amount is taxable. The only thing a person can do is if his slab rates is something that he can take the benefit of. Apart from that, if a person has borrowed some funds to buy these shares, so the interest paid on these borrowed funds can be claimed as an expense from the dividend income. However, this expense should not be more than 20% of the dividend amount. So say, for example, a person has earned dividend of 20,000 rupees, he can claim interest as an expense up to 4,000 rupees, which is 20% of 20,000 rupees.
Okay, but are there any avenues at all to lessen your tax, the quantum of tax that's payable because of your dividend income?
The dividend is now treated like other incomes. So number one is you take the benefit of slab rates. Number two is you take the benefit of these reductions under Section 80C where you invest 1.5 lakhs, or 80D, which is for health insurance premium, or 80CCD. So now dividend is taxed as other incomes only, just like we pay tax on all the other incomes, and we can claim the deduction under chapter schedule 6. No specific deduction available in this case.
Any other facts that one should keep in mind as far as dividend income taxation is concerned? I mean, how or what are the points that you need to keep in mind while filing for the same?
So dividend income, now what will happen is it will get reflected in the form 26 AS. So from there you can fetch it. Moreover, the demat account with which you have all the shares, then that will mention the amount of dividend that you earned. And this you disclose as income from other sources, the dividend part. So the entire part goes as income from other sources, and entire part is taxable. So this is for this year onwards, for which you will be filing the returns in next July. Right now you are filing the returns for the previous year, FY 19-20. In FY 19-20, the dividends were tax exempt. However, in FY 2021, the dividends are taxable, for which a person will be filing the returns next year, that is in July.
Okay. Okay, that helps put things in perspective. Once, coming back to the tax filing aspect of it, because the deadline is nearing for it for this year, once you have filed for your interest, typically what is how long does it take to be processed, and how can investors and taxpayers track it?
See, for people who filed returns in, say, July 2020, the IT department was taking time. So that time it was taking around 3-4 months for the IT department to process the returns. However, now they have increased the speed of processing, and now within 3-4 weeks, the ITR is getting processed. Number one. Number two, when the ITR is processed, normally, typically a person receives an SMS as well as an email. In the email, they mention, okay, the ITR has been processed. So they receive an intimation under Section 143A, wherein the income that we've disclosed and the income which the department has accepted, everything is mentioned. And the refund part or the tax payable part is also mentioned in that. So if it is zero or if there's a refund, then nothing is required to be done. However, if there's a tax demand, then you should ideally pay it.
Okay. All right, makes sense. Slipping into a break here, Karan. Stay on with us. We'll address some of our viewer queries also on the other side of the break. Request you to be on hold. Welcome back. You're still watching The Money Show on ET Now. Karan Batra is still with us, and time to help our viewers out with their daily queries that they have. First up is an email from Mr. P.K. Rakshit. He said that sometime back, mutual fund houses furnished investors yearly investment values more than 10 lakhs a year for last few years to Income Tax Department for introducing in 26 AS form. Now, Mr. Rakshit says he has 2 mutual fund folios in his name and other in his wife's name, each with a joint holding. When he downloads the 26 AS form for the last few years, he's found the reported amount by mutual fund houses under SFT 010 to be much more than the purchases made by him and his wife. On checking with the mutual fund, they indicated that the reported amounts for each PAN was for all the folios covering joint holders' purchases also. Thus, they are clubbing other PAN's investment during the year under his PAN and reporting it to the Income Tax Department. Is it a correct way, and could it be explained for his clarity? Is something that he is seeking from you, Karan. If you could help him out, understand why this is happening.
So now government has made a change, wherein in Form 26 years, they have also introduced the SFT transactions. So SFT stands for Statement of Financial Transactions. And if a person has made investments in any mutual fund or fixed deposit or other investments worth more than 10 lakh rupees, then these are being reported in the Form 26 AS. And these are being reported by the bank or the fund house with whom you have the mutual fund. So what has happened is the mutual fund house, they had the PAN numbers of both the husband and the wife, and the entire amount has been disclosed in both the names. Now, in this case, the government, as of now, has not given any clarity on how this is required to be reported in case of joint owners, number one. Number two, there's no way to get this amended as well. So this is something that is happening. A lot of fund houses are doing it. A lot of people are getting confused as to what is to be done. So as of now, nothing is to be done and nothing can be done. Tomorrow, if there is a query, yes, this is easily explainable that these investments were made through the joint names, and half of it belongs to you and half of it belongs to your wife. So yes, this is easily explainable, nothing to worry about till the time this investment was the tax-paid money.
Okay, I hope Mr. Rakshit understands now what exactly it means, especially after Karan has made it, or rather simplified it for him. Let's move on to query number 2. It's from Shiv Kumar Burley. What is the tax implication if I redeem partial amount from debt funds? That's the question he has for you. Karan, take it away.
So if you withdraw a partial amount, then you will have to pay tax on the partial gains that you make. If these were held for less than 3 years, this would be classified as short-term gains and taxable as per the slab rates. If these were held for more than 3 years, then this would be taxed at flat 20%.
Okay. Well, there you have it. And moving on to our third query, Srinivas MG has written to us asking if he should pay any tax for short-term capital gains from debt fund. His income is zero in the financial year in question. What would be your advice?
So in case of short-term capital gains, if his income is zero and these short-term gains are less than 2.5 lakh rupees, then there will be no tax that is applicable. So he is not required to pay any tax on these because his income is not taxable.
Okay. All right. Then moving on to our last and final query for the day. Manish Keswani has written to us. He says if you have a joint property between father and son, can the son claim HRA benefit if he pays rent to his father due to financial requirements claimed by his father? So here's a situation, Karan, which a lot of these service class people tend to face, especially the ones which are living in a joint family setup with parents and with other relatives who perhaps would be paying rent to one another. But can it be claimed under HRA? That's an important question.
Yes, I know a lot of people do this. And the good news is, yes, a person can claim this. So if a person is paying rent to his father or mother or say brother or sister, yes, you can claim this benefit. However, if a person is paying rent to the wife, then this cannot be claimed. So the logic basically here is that a husband and wife is treated as one family. But father and son, the law treats them as different families. So if a person is paying rent to his father, then yes, this deduction can be claimed, or rather the HRA benefit can be claimed. However, it is important to note that the rent should be paid via bank transfer. The PAN number of the father should be submitted to the employer. Moreover, there should be a proper agreement in place and there should be proper rent receipts. I've seen many cases where people don't have all these documents and tomorrow such people may land in trouble. So it is advisable that when you're paying the rent, you do all the documentations necessary.
All right. Okay, there you have it. All the queries answered as well. And I hope our viewers have much more clarity about their concerns and their doubts, which they perhaps had before in their mind with return to claiming HRA or saving their tax, etc. Thank you so much, Karan. It's been a pleasure chatting with you and getting in your perspectives on a host of issues with regard to personal income tax.
Thank you.